Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello and welcome to this special edition of Standard Chartered Money Insights. This podcast is part of a mini-series surrounding our 2022 outlook, which was released this week. Our theme for the coming 12 months is a winding road to normality. Today we'll be talking about the outlook for FX or currencies. My name is Steve Brice, I'm the bank's Chief Investment Officer, and I'm very fortunate to have with me DJ Cheong, who is our FX specialist within the CIO office. So DJ, let's get straight into it. So the dollar's resilience has caught most market participants off guard this year. Do you see the rally as continuing into 2022?
That's a great question, Steve. I think we acknowledge that the dollar rally has been difficult to ignore. We are expecting a range-bound dollar with a bearish bias. Now, if you consider rising short-term US bond yields and expectations of a Fed policy lift-off, this means the dollar rally still has some room to go. But beyond this horizon, we believe fundamentals still point to a weaker dollar over a 6 to 12 month horizon. Here are some reasons why we believe so. So firstly, we see the dollar reconverging with inflation-adjusted yield differentials that will remain dollar negative once a Fed tightening cycle is fully priced in and attention moves to an eventual policy shift outside the US. Secondly, as global growth picks up, relative growth differentials should begin to favor non-US markets. This should move towards a greater outperformance of non-US equity and bond markets, which could kickstart a turn in the dollar later in 2022. Lastly, the large US twin deficits is also a headwind, with the dollar looking quite expensive from a valuation standpoint. Now, we can't talk about the dollar without covering the euro. Now, we believe euro area growth might positively surprise as pandemic waves subside and more fiscal spending is deployed by the new German government and across the EU. The March to April period may be pivotal, with the ECB due to confirm its asset purchase strategy, and we have French elections due as well. Long story short, the speed and timing of the dollar reversal will depend on the evolution of the Fed's policy and the commitment of both Europe and China in deploying fiscal stimulus.
Okay, so the team's view is for a range-bound dollar with a bearish bias. So which currencies, if any, do you expect to outperform the dollar as we go through 2022?
Now, our top picks for 2022 are for the Australian, New Zealand, and Canadian dollar. We expect them to appreciate against the dollar due to stronger domestic growth, faster monetary policy normalization, buoyant commodity exports, and attractive terms of trade. Now, I'll talk you through each currency individually. So, starting with the Australian dollar, we believe headwinds from a dovish Reserve Bank of Australia and slowing Chinese growth should gradually fade. The Australian dollar is also cheap relative to commodity export prices. Now, stronger employment and wages may also boost house prices and push the RBA to a more hawkish stance. Net short positioning for the Australian dollar is also looking quite stretched and looks set to mean revert. Now, this will be a tailwind for the currency. So key support is expected at around 67.50 and is expected to climb to around 76 cents against the dollar over the next 6 to 12 months. Now let's move on to its neighboring currency, the New Zealand dollar. Now, the domestic New Zealand economy is already leading the global rebound. The Reserve Bank of New Zealand is one of the more hawkish central banks around relative to the Fed, given the strong employment, wages, and inflation, as well as robust house prices we are seeing in New Zealand. So we expect the New Zealand dollar to gradually grind higher towards 72 cents against the dollar over the next 6 to 12 months. And lastly, the Canadian dollar. We expect dollar CAD to peak soon. For one, the Bank of Canada, like the RBNZ, remains hawkish as Canadian growth retains its strong upward momentum. Rebounding oil prices and stronger exports into a robust US market are also tailwinds for the currency. So going back to the bigger picture, we expect risk-sensitive currencies to pick up heading into the new year as investor sentiment improves alongside global growth.
Okay, DJ, thanks for that. So just one last question for you today. So what are the upside risks to the dollar? Obviously, we never know exactly what's going to happen, but what would happen if the dollar was to strengthen? What needs to happen for the dollar to strengthen?
So I'm going to use the dollar smile framework for this. I think that has US versus rest of world economic data performance on the x-axis, really split between risk on and risk off phases, and dollar performance on the y-axis. So this suggests the dollar usually outperforms either in a global risk off environment or when US growth outpaces the rest of the world. These are the left and right sides of the smile respectively. So for the left-hand side of the smile, we believe the dollar could rise on safe haven demand as the Omicron variant begins to spread. Now, this would require severe mobility restrictions and tighter policy all around. This dollar feedback loop could also play out via the financial channel route, where a stronger dollar will affect economic activity through its impact on financial conditions. Now, on the other hand, we believe the right-hand side of the dollar smile, where US growth outperformance continues, is the one to watch for. In that scenario, the Fed will likely be more hawkish than expected, propping up inflation-adjusted yield differentials in favor of the dollar. Dollar-denominated assets may also retain their attractiveness. That, in our view, presents the biggest upside risk for the dollar.
Okay, DJ, thank you so much for your insights today. That is all we have time for on this special episode of Standard Chartered Money Insights. But if you'd like to learn more or read our publications, please visit our website at sc.com under Market Insights. As a reminder, if you enjoyed our discussion, please rate and review us wherever you get your podcasts. And thank you for joining us and enjoy the rest of your day. Stay safe.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.